So today I want to talk about currency exchange rates again, where they are, where they might be going. Now, I do have other videos on this topic. You can see those videos if you follow these links here. We talk about purchasing power parity, interest rate parity, the Big Mac index. Today, I want to think about balance of payments and how we might use that to determine where exchange rates are headed. As you recall, the FX market, the exchange rate market, is very liquid. You see some prices to go from one currency from the dollar. You also notice that these exchange rates change daily by a little bit. Now, of course, we want to determine or have some mechanism for determining how we might think about what the exchange rate should be or where it's going. Today, we're going to think about the balance of payments. This is broken up into two components. One is called the current account. That is goods and services, merchandise. It also includes things like payments from an investment you made. So if you invest in another country and you get a dividend payment, that goes into the current account. These are just things that are consumed now. That's why it's called the current account. The other half of this is called the capital account. And this is really the money that's exchanged for those goods and services. So it's the counter transaction to that. It includes things like foreign direct investment, foreign portfolio investment. Again, it's just the money. Now, I do have some other videos out there where I talk about foreign direct investment in more detail. You can check out those videos here. Now, to further complicate things or can make things more confusing, sometimes the capital account itself is put into two components. One is called the capital account. That is physical assets. So if you were to buy a house or a manufacturing plant or some kind of physical asset, that would be part of the capital account. The financial account would be monetary investment. So if you're buying a business, not necessarily the physical part of it, but you're investing in a business, that would be the financial account. Importantly, this does not include things that contribute to income or production or savings in that country you're investing in. So let's just cross that off there. Now, as I said before, these things do balance. So here is the U.S. You can see that the U.S. has a current account deficit and a capital account surplus here. Now, the way this affects exchange rates is really by demand, right? So if I in the US want to buy something from you in France, I can't just take my dollars and give you dollars. I need to convert those dollars into euro, and then I can pay you in euro. So when I sell my US dollars, that increases the supply. When I buy your euros, that increases the demand, and that shifts kind of this equilibrium in such a way that the dollar depreciates versus the euro. That's the idea here. So the idea, well, does this actually help us predict things? Unfortunately, the answer is it doesn't really help us that much in terms of predicting future exchange rates. It's slightly better than random, but it's not that great. Now, the long and short of it is that exchange rates are complex, and one single thing isn't going to help us perfectly predict the future, whether it's interest rates or it's purchasing power or it's balance of payments or the simplicity of the Big Mac index. It's just more complex than that. Hope you enjoy this. Thanks so much. I'm Brian Kozlowski.